Are live. What's going on, everybody? Welcome to Wolf. Very excited to bring you this conversation today. We're doing another ETF conversation. We've got Paul Marino, joined by Paul Marino, Chief Revenue Officer at Leverage Shares and Themes ETFs. He's been in the industry for a very long time, and he's going to be joining me in my goal here to let people know more about the ETF space, because there's more opportunity here than a lot of people, especially the young people, know about. They're chasing the new coin, the new stock, but there's tons of opportunities here in the ETF world. And so, Paul, I would love for you to give a quick little introduction on yourself and Leverage Shares and Themes, and then we'll dive into it, because you guys have some really cool stuff that's coming out right now, and I think it's perfect time to talk about it. We had Jerome Powell was up yesterday, so everyone's eyes are glued on the market right now.
Yeah, so thanks for having me on, Cato. It's always a pleasure to be on with Wolf. We really love the participation. So just really briefly on me, I've been in the asset management space now for 25 plus years, building and growing sales teams, business development, marketing, you name it. Started off on the asset management side in mutual funds, traditional mutual funds, because I'm that old and that's what was the thing to do back then. But we've seen a cosmic shift from mutual funds to ETFs, and there's a really good reason for it. First and foremost, they're lower fee. And the second reason is that they are way more flexible. You can do a lot more with an ETF and inside of an ETF wrapper than you can with a mutual fund. And the third reason, obviously, is just exactly what they stand for: exchange traded funds. They're daily liquid. They are fully transparent. They trade on exchanges, so people have lots of access to them. And, you know, a lot of people get the idea that ETFs are just these very, 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 very low cost, broad exposure to indexes. And in a lot of ways, that's what they started out as, but that's not what they are at all. In fact, the biggest innovation probably in the financial space is the ETF and all that it could do, because it allows people to get access to just about any market on the planet, whether that's public, private, crypto, you name it. You could put that into an ETF wrapper and people can get exposure to that in a daily liquid form, very, very inexpensive, and they could trade it daily on an exchange. And so incredibly important innovation in our business. And, you know, if you're thinking about ETFs as just broad index, low cost, that's not what they are at all. There's so many more things that you could do with an ETF. And firms like ours, Themes ETFs and Leverage Shares by Themes, you know, we believe that we're leading that charge to offer high conviction investors the exposure to the highest growth areas of the market, so that they can, you know, generate the kind of returns that they want at an affordable price.
That's fantastic. I think it's a great introduction as well for the conversation, because people just had the wrong idea. So for you guys, you have the new cap accelerated ETF. But there's also a slew of different products you guys have. And so I kind of want to start with the new one and cover this a little bit. If you could just give a bit of an introduction on this. And also, you know, when this might be helpful before you do, for people who are like entering this world and they're like, okay, so there's a company, Leverage Shares and Themes. They come out with products and then they launch sometimes, and then, you know, every 4 weeks, or every 4 months, there's a new product. Is there a place to pay attention? I guess for the new person who's kind of just getting introduced to this conversation, you guys, how should they get involved, I guess, as well?
Yeah, number one, I would say pay attention to everything that you can, right? Form high convictions about where you want to invest, and then go out and find it. And what you'll find is that we've done a lot of that homework for you. So, you know, maybe I'm a little bit biased, but I think a good place for you to start is with Themes ETFs and Leverage Shares by Themes, because we're right at the forefront of providing that high growth exposure to investors, whether that's in our thematics or sector-based funds, our 2 times leveraged single stock ETFs, or what we could get into right now to start, which is our capped accelerated series. And so essentially what we did was we heard from investors that, you know, they really wanted an opportunity for amplified returns, but they were worried about amplified losses if they didn't time the market right. And so, you know, if you're a day trader or you're a sophisticated retail trader, and you either have your own algorithm or you have your own system, and you're on this day in, day out, and you understand how those single stock leverage products work, you know, those are really good for you to amplify your exposure when you're trying to make a move, right? But for those who aren't, or for those who aren't looking at their screen all day, but they still want that opportunity, there's options out there, but options are complicated for just the ordinary investor, and they can be expensive, and you don't really know how to price them, and you can't trade them after hours or before hours or anything like that. So what we instituted was an option strategy inside of an ETF. And this goes back to what I said before about the ETF wrapper. You could do almost anything you want. So it's taking into consideration the goal of getting an amplified return to the upside. So we're aiming for a 2x return to the upside up to a cap. The reason why it's capped is because we are providing you protection on the downside. So while you have an amplified return potential on the upside, you're only getting 1 times downside. So essentially, if one of the underlying securities, one of the ones that we will launch is Strategy, MSOO. Okay, if Strategy is up 5%, we're looking to get you 10%. But if it's down 2%, you're only going to lose 2%. So it's an opportunity for amplified returns up to a cap, but only 1 time the downside. So think of it as a structured note inside of an ETF wrapper. That's what we're offering you for single stocks. And we have it available for Strategy, Palantir, Tesla, NVIDIA, and Coinbase.
What's the most exciting for people when they hear that list? I feel like everyone just gets excited. They hear the big names, they just get excited.
It really depends. I mean, recently it's been Palantir and Coinbase. I was on with you guys earlier in the week and last week, and I tried to bring awareness to Strategy, because Strategy, the way these work is on a point-to-point basis, starting at the beginning of the calendar month and ending on the last day. So essentially, it's a point certain ETF in the sense that we set the cap for the month on the last business day of the prior month. And then we close that cap out on the last business day of the next month, and we start a new cap. So essentially, what you do is you look at that cap for the month, and then you decide whether or not you are in favor of a move up in that security. And if you are, we're going to offer you an amplified return depending upon what that cap is. Also important to note that if you wanted to get into this on a inter-month basis, you can, because again, it's an ETF, it's daily liquid. So you can get into it in the middle of the month. But what I would ask you to do is look at what the quote unquote remaining cap is, because that changes as the month goes on, depending upon what the underlying security does. So the reason why I brought attention to MSOO, the capped accelerated ETF that represents Strategy, is because Strategy did not get included into the S&P 500, even though it met the criteria. And that was a disappointment to investors. But what that did was it moved the price of Strategy down, even though Bitcoin started to make a little bit of a rebound. So when you looked inter-period, the cap rate didn't go down. It actually went up. You had more of an opportunity to get in inter-month and capture more. So when I had said this last week, it was about 15.97% with only about 16 days remaining in the month. And so if you thought, Strategy might return 5 or 6 or 10%, you had a really good chance with only a few days left in the month to get an amplified return as you got closer to that strike price if you got in during that month. So what I would say is the way to evaluate these things, and everybody looks at it a little bit differently, you want to look at the underlying security, how you feel that's going to move, and what the actual cap is, either at the beginning of the month, what the total cap is, or what the interperiod cap is, the remaining cap, and make a decision if you think you have an opportunity for that amplified return based on your conviction that the underlying security is going to go up. And if you believe in that and you think that, you have a good chance for an upside return. The other thing to take into consideration on these things too is the time value. Because as you know, when you're trading options, right, they have a time value. As you get closer to that strike price, the price of the options basket starts to catch up, and you can make up for some gains. So there was another point last week where Tesla had time value built into it because the stock moved up a little bit. There was still a good remaining cap, but it hadn't caught up in time value to the strike price. So you had about 3 or 4% built in that if you just got in on that day and Tesla didn't move at all for the rest of the month, you could have earned 3 or 4% just in time value alone. So again, do your due diligence on these, ask a lot of questions. And what I would say to you is please go to the website and read everything you can about how these work. We're looking into creating a new time value component to it too. So that will show you what I just discussed, and we should have that up soon. But it shows all the remaining, all the monthly caps, all the remaining caps, and what the value of that option basket is today on a chart. So you could see minute by minute what's happening. And then the last piece of it is, again, because they're daily liquid, let's say you get into one of these things and the stock shoots up like a rocket. Let's say your cap was 10%. And in a day, the underlying security goes up 30%. And even with time value, you're at that cap. There's not a lot more that you could do. The cool thing about it is you're not penalized. You could trade out of that day and get the maximum that you could get in that options package, right? So hopefully at the cap or just below it because of the time value. And then you could reposition that into something else and you get those gains. So it's a really interesting product that takes into consideration risk management while also understanding that people sometimes are looking for amplified returns, but they really can't stomach that amplified downside.
I agree with you. And honestly, I saw a lot of that rhetoric yesterday around, the Jerome walks up, he says things, and the market goes crazy for a little bit. And then, like especially with Bitcoin ended up just going back up and trudging forward. For me, I mean, I'm not sure what you guys think. I guess in my head, it seemed relatively clear. I'm like, it seems like he's just saying, yeah, we're going to slowly wade our way in. And I just don't, I struggle to find the arguments that assets are going to lose against the dollar. And I can't for the life of me figure out the argument that we go down from here. Because I'm like, why in any scenario would the US dollar outperform the assets? And so I can't think of that scenario. I'm curious on how you kind of took it and what your thoughts were from the meeting yesterday.
Let me start with a far more brilliant and successful investor trader than I will ever be, David Tepper, who was on CNBC this morning, and he reiterated, do not fight the Fed. Like he's been saying that for a long period of time and he's never been wrong, right? So it doesn't matter how much they're going to do. They're going to ease. Like you should put that into your calculations because when they ease, valuations go up. Now we had a really interesting situation where the market went up even in a rising interest rate environment, but that's because we are in a technological revolution that involves AI and crypto. Like we are revolutionizing not only technology, but the financial system. And that has been something that is unprecedented in modern days. Like we have never seen that. It's even bigger than the dot-com boom, okay? So it's way bigger than the internet and the dot-com boom. And this thing is pouring in investment and it's not going to stop for a long period of time. So that helped us gain because we were able to outgrow all the problems and all of the issues with rising interest rates and a Fed that was hawkish and not dovish. But here's the situation. I keep telling investors the Fed's going to do what the Fed's going to do. You still should be looking for the highest growth areas that you have the highest conviction in. Again, I would say things like AI. I would say things like crypto for certain. I would say things like defense, because that is big. I would go with like very secure financial institutions like the G-SIBs, because in a high interest rate environment and a low interest rate environment, they excel because of their scale, because of their interconnectivity, because of their lack of sensitivity to interest rates. So like make sure that you still have high conviction no matter what, so you can handle the volatility. But at the end of the day, the Fed's in a pinch and the Treasury's in a pinch because
it was
really
bad.
Like think about their dual mandate. Their dual mandate is employment and inflation, right? So they know if they lower interest rates too fast, inflation will go through the roof, right?
Yep.
Well, they can't really take that stance. But the problem with employment could be fixed with a lower interest rate, right? But what will that do? That's going to cause all sorts of problems other places. So they've got a dual mandate, but the tools that they're using don't necessarily jive with solutions for each one of that side of the dual mandate. And then on the other side of it, I keep hearing people, and I want to shout from the rooftops. I gotta publish this somewhere because this is the key. Like we are trying to solve the wrong problem. We keep saying Fed's got to lower interest rates so we could fix the housing affordability issue. That's what caused the housing affordability issue. Jamming interest rates down to zero, increasing the valuations of homes because people just kept saying, oh, my monthly payment is less. My monthly payment is less. But let me ask you a question, Kate. You're a smart guy. You're an observer of the markets. When interest rates went up, did the valuations of homes come down? No, they stayed where they were because they're seller dependent. The seller sets that. And sellers, regardless of what the interest rate is, don't want to go to the table when they sell their house and write a check. So they're holding on for dear life.
Yeah.
Lower interest rates does not help the buyer. Lower interest rate does not help the buyer. It only helps the seller in some way by maintaining high valuations on homes and lowering the monthly interest payment. That's not a solution for housing. And so the reason why, Jerome, like I know, look, I lean to the side of where Washington is today, but I have to tell you, I have issues with this thought that lowering interest rates is the solution. It will help us with the debt for sure, but we should have never gotten into the debt in the first place. We should have a Congress that really takes care of that, right? And I would say that when you have Elizabeth Warren and Donald Trump both agreeing on the same thing, which is that interest rates have to go down, you know there's a problem. You know that's not the solution. Like, no way is that the solution. When two of those people agree, that's not the solution. So
do you think it's a different place? Do you think that specific detail is actually interesting? Do you think we're in a different place in 2025? Like all the Bitcoiners, of course, half of them are saying we're in the fourth turning. I mean, it is over, is what they're saying, and then half of them are saying no, we'll have business as usual.
It doesn't end overnight. We're going to have business as usual until we don't have business as usual. I have a great friend in the industry. He's super great at charting and tech and all, and he's a great technician and all that stuff. And he always says, like, it goes until it doesn't go anymore. But trees don't grow to the sky. And at some point, you get on the elevator, and they close the doors, they double padlock it, and they hit the down button, and it just goes. And you never know when that is. Like, I don't care if you're an economist. I don't care if you're a Federal Reserve Board chair. I don't care who you are. You never predict that. No one predicts that. The only guy that predicts that comes on, TV and everywhere else afterwards and says, I always get it right. But he only got it right one time, and he guessed 500 times before that wrong. He just kept guessing. Well, he just kept guessing the same thing until it happened. Like, I could sit here and say, crash is coming. Next week, crash is coming. Next year, crash is coming. I could say that. I could have said that for the last 15 years. But we always had these V-shaped recoveries, and anybody who believed in that and put their money into that got their, what handed to them. Yeah. So my point is, we have some real issues for the crypto people. Like, I'm a big crypto bull. I love crypto, and I see that as a store of value. I see that as a way to actually, like, beat the system that's trying to destroy the value of your dollar. Like, no doubt about it. And I think there's a great stat that shows, 10 years ago, it probably cost you something like, 1 million Bitcoin to buy your dream home. Now it's like 5 or 6. Yep. So who's doing better?
Yeah, that's a great point. Do you think the system, we had a fiery debate about this the other day on a space, but we had one side take the side that he was like, hey, look, he's like, I've been in Wall Street for 40 years. He goes, I left because the system cannot be fixed from the inside. Elon Musk went to the government, left because he realized it couldn't be fixed from the inside. He goes, this thing cannot be fixed from the inside. You need to find a new protocol that's Bitcoin. The other side was, no, we haven't tried enough. We need to keep hammering at it. And I could see the argument, because it's like, you can't tell the other guy no, because it's like, yeah, I guess there's always a chance you could. And we just haven't seen it. But in my head, I'm just like, I don't know. Do you have any thoughts on this?
Here's why you can't fix it. Because even though we're at, like, what is it, like $37 trillion in debt, the money's gone. It's in money heaven. They don't keep it in a vault somewhere. So it's not like you could fix this thing and figure out how to do it, right? And besides that, there's more money coming into money heaven every day. It's called the deficit. And we fail to meet a budget, right? So, like, it's just, we keep killing dollars. That's it. And they keep going to money heaven. And there's no way that we could grow out of that. Plus, we're not even talking about all the entitlements that get into the hundreds of trillions. And where's that going to come from? So there's no way to grow out of that. And there's no way. So again, even the coolest heads, the people, the most fiscal conservatives, will go in and they have great rhetoric and they say all the right things. And I want to believe them. But when they get in, the only problems that are there to fix mean pain. And what do politicians on any side not want to cause? Pain. They don't want to cause constituent pain. You cause constituent pain, you're voted out, right? Yep. So that's why, this is a whole nother job. You should have term limits on Congress so that they are in and out to do the right thing, and they can't make it a career. They shouldn't get health benefits or anything like that. They should be civil servants that come in and volunteer. And that should be how it is, like the old days in the revolution where they actually cared about the outcomes. And then, we're going to have to figure out, like, is the Federal Reserve System actually prudent for Americans and for the economy? And I would argue that too. I don't think it's ever done anything except increase the debt, lower the value of the dollar, and benefit the banks. Like, again, everybody's like, the American dream, home, buy a home. No, that's a bank's dream. They made more money off that than anybody else. And I'm not saying that they can't do that. They're in their legal right to do that, and they promote, and they're all fair. But man, have we really promulgated this thought that like you should buy a home, you should
Yeah.
refinance. Like when Ben Bernanke, the Federal Reserve chairman, came out and told people you should refinance because interest rates are low, all he did was re-amortize for the banks. So there were people that were 15 years into the loan, they were paying down principal, and Ben Bernanke convinced them to refinance their loan, re-amortize, and start paying the banks more interest.
I've heard the argument. They've said, you know, I guess their argument is such that they're like, look, it was decent. It got some things moving. People made some money. In my head, I'm like, yeah, but there was 1,000 alternatives that were not nearly as toxic as this.
Look, all it did was lower your monthly payment and make their data look better so that they could say that GDP was higher. It's manufacturing GDP. Okay, that's what we do in this country. We manufacture GDP numbers so that we can say that we're growing. And we don't care how we do it. We don't care if it's based on personal debt. We don't care if it's based on college debt, from tuition loans. We don't care if it's re-amortizing your mortgage so that you can have a little bit less payment here, but still be paying way more interest over the long term, right? So you're becoming poorer. Yeah. But then you also have a couple little extra bucks to spend on groceries and maybe a flat screen TV now that you've lowered your monthly payment. I mean, that's just not a good solution for anybody. It never was. And nobody wants to talk about it because they just want the gravy train to keep rolling. And I want the gravy train to keep rolling too, but I want it to be done in a way that is maintained. And what I've done is, like I said, I've looked at those high conviction areas that I really believe in, or I can get exposure to them. And that's where I'm putting my dollars in. And that's what whenever I come to these things, I don't make recommendations. I just say, hey, go find where the money's going, go find where the growth actually is, and find out the way that you can get the highest exposure to that at the lowest cost. And if you can do that, that's what it's going to make you healthy and wealthy. And that's the one thing I love about being at Themes ETFs and leverage shares by Themes. We design and distribute instruments for people to get access. We don't tell them what to get access in. We don't make recommendations, but we give them tools so that they can get access to that. And we do it at the lowest price on the street. And that makes me happy. That makes me proud to be a part of the organization because that's what it should be all about.
Agreed. And I think people at CPA also comment, I like this gentleman. I agree. I think Paul's awesome. You're one of the realer people I've seen from the traditional finance side of things who will just say the truth. They're like, this is the reality, but this is also the reality. I'm curious on what you think about this. Kind of a random question that popped in my head, but in foreign investing, if you were like, if someone's new to the ETF space and like, okay, there's all these opportunities in the stock market. Everything's US based though. Are there opportunities abroad and internationally and foreign for like, is that, I don't know. How do you think about that?
Yeah, absolutely. So I'm not a big believer in you just go to foreign markets, just go to foreign markets, or emerging markets, just go to emerging markets. Like if you want to get your exposure that way and you want to be broadly diversified that way, fine. I don't believe in that. And I was just talking about this on one of the prior discussions that we had this week. Like to me, it's not about the where, it's about the what. And when you find the what and you are highly convinced about the what, you go get that what wherever it is. Okay. And so I'll give you a couple of examples. Our fund, our ETF, NATO, NATO, Transatlantic Defense ETF by Themes. Okay. It is an ETF that invests in aerospace and defense companies in NATO member countries, including the United States. What do we know? There's a massive commitment to spending across the board in US and NATO member country defense companies. And it's 2% of NATO member GDPs to 5% over the course of 10 years. That's going to continue to rise as their GDP grows. It's going to continue to rise more, and they have to spend it. Why not put something there? And it's in European and US companies. Both will do well because US is the expert right now, and they have the best technology and armaments. And Europe is trying to catch up and be more self-reliant. So both will do well. Don't care about the where, care about the what. That's where the money's going. I want to be in. Talk about AI. Got to have investments in US AI. We have an ETF called WISE that encapsulates that. Revenues from artificial intelligence, right? But also, there's another entirely different market that nobody really has access to, the Chinese AI market. And people are always trying to say, well, US is going to win. It doesn't matter if US wins and China takes second. This is a huge growth market in the world. And so even if China takes second, which I'm hoping they do, because I don't want them to beat the US. I don't want anybody to beat the US. I'm an American citizen, right? If they take second, that's still an incredible investment return. So we are offering Dragon, DRGN, which is exposure to only Chinese mainland AI investments. So companies that make their revenue from Chinese companies. And we've done it on a US exchange and a US ETF, US tax consequences that you could trade daily, every single day at a low cost. So now you don't have to worry about becoming an expert in China, opening up accounts and doing all that crazy stuff that you could never accomplish anyway. You could get it right through us. I talked about the banks, right? I don't care where the banks are. If they are the largest, most systemically important banks that have been designated that as GSIBs, they are the ones that are most resistant to any kind of move up or down. And they are the ones that are going to win for all the reasons I said before. So we have an ETF, GSIB, GSIB, and it is comprised of those 29 globally systemically important banks. We believe will outperform in any market, and it's doing very well. So that's something that I would consider as well. And then you got to think about some other markets like uranium, powering, clean energy, the future of clean energy. Trump just talked about it today with the Prime Minister of Britain, how they're creating all these microsites around Europe to power Europe. Like, you need uranium for nuclear microsites. So think about those places, get high conviction, and find a vehicle that could give you that exposure. I think we do that really well.
I love that. And by the way, just for clarification, before we wrap, when you say like words like instrument, vehicle, things like that, that's really just a collection of various investments. When people are
our ETF.
Yeah, exactly. And when people jump into it, are they, for someone who's new, are they expected to say, okay, I jump in, I get the ETF. This is something I trade daily, weekly, monthly. This is something I just get in and just kind of let you guys handle? Or how do they? How should they think about
ETFs,
this?
if you think it's going to grow and you think it's a high conviction place, it's only underlying companies, and you can see what the underlying companies are, and they're all very liquid, right? So you don't have to worry about it. You could stay in. There's no daily resets. You get in. The only thing you have to worry about over time is your expense ratio, but we have very low expense ratios, the lowest on the street, 40% lower than our competitors. So all you have to do is be high conviction, put some money in, and you decide when you want to get in or out. You can get in 20 minutes later.
Like it.
You can get in 20. You can get out 20 years later.
There's
no requirement.
I like that.
And there's no decay. So you don't have to worry about that. The only decay is the expense ratio. And obviously, if you picked it wrong, I mean, like if you're not in a good market and you didn't pick the right sector, that I can't help you with.
Right.
I wish I could, but I can't.
Well, listen, Paul, I really appreciate you coming on. Like I said, I love the ETF conversation. I am stoked to learn more every time I speak with you. It is the best part about working here at Wolf is the just expertise. We're able to just, link up with people who've just been in the industry for a long time and seen things come and go. So, Paul, thank you so much for coming on. I wanted to turn it back over to you for any final thoughts, last things you want to throw in before we wrap.
No, anytime, Kate. It always goes by so fast. So
it does, right? It does. I don't know how it flew by.
And I got like a little sweat going. I'm all enthusiastic for the rest of my day. You guys get me pumped up.
Let's go. Well, I appreciate it, man. And for anyone who's interested, definitely check them out in the YouTube description down below. And if you're on X, right below in the tweet below, whether it's Wolf Financial or Wolf Bitcoin, wherever you're watching, it'll be a Wolf Bitcoin tweet, but it'll take you there and you can check everything they have. And I highly recommend you guys sift through the various ETFs they have, find one that works for you, or at the very least, just get involved and start educating yourself. They've got a lot of stuff there, not just the options to invest in, but there's some good stuff on their site. So definitely recommend checking it out. And look, we have spaces streams every single day here at Wolf. I know on Wolf Bitcoin, we've got a space starting here in like 30 or 45 seconds, talking about RWAs, Bitcoin mining. Then we're going to talk about the market. So we got a whole lot of stuff coming. We'll catch you guys all in the next one, everyone. Have an amazing day. Take care.
Take care.
And boom.